What if I told you that if you're a real estate investor, you could pay $0 in taxes with just one move? Over the past 3 years, I have helped clients save thousands of dollars in taxes implementing this strategy. And while it's a little bit misunderstood, it's completely legal, and it can be the difference between you begrudgingly paying Uncle Sam and ripping that check up and going on a shopping spree. So in this video, I'm going to share my screen and show you step by step how this strategy works and how you can implement it so that you can win big. So let's jump in. So I have a similar walkthrough that uses similar numbers. And that's just talking about the benefits of depreciation. You can click the link for that if you want to learn how that works. But let's just kind of fast forward and we're going to pick up where we left off. And so we have a building, and this building is worth $725K. We have a NOI, or net operating income, for this property for the year. Let's assume our tax rate is %. We are going to take bonus, and this will come into play a little bit later. That's 40%. And then we have our breakdown of what we were able to pull forward with the cost segregation. All right, so we have the basis of our problem here, and then let's take this a little further so you can see exactly how this works. So with a cost segregation, what happens is that, as I said previously, you have the total value of the property. And so in this instance, our total property value is $725,000. But now we've had a cost segregation study done by an engineer, and we are able to bifurcate out these different segments. And so with these segments, what happens is that you have some that are depreciable over 5 years, some that are depreciable over 7 years, some that are depreciable over 15, and then the rest remain with the useful life of 39 or 27 and a half years. In this instance, we are assuming, let me show you what happens without the cost segregation, and we'll come back to the breakdown. So without the cost segregation, we know that our depreciation expense for the year is going to be $26,363 and 64 cents. So what happens is that we now take our taxable income for the year, $600, and we are going to subtract out depreciation of $26,364, and we have, actually fix this because it's not our taxable income. This is our NOI. Just wanted that to be clear. This is our depreciation expense. This is before cost segregation, so we understand that. And we get to taxable income of $19,236, which equates to tax of $7,117, and that's at our 37% tax rate. So I hope this walkthrough is helpful so far, but I just want to let you know that if you're looking for other strategies that can help you save in regards to taxes, click the link below and sign up for our newsletter called the 0% Playbook. We talk about strategies in layman's terms every single week to help you maximize at tax time and pay as little as possible. So let's get back into the walkthrough. Now, let's show what happens if we have a cost segregation. And because this is where it gets really, really powerful. So that same property that's worth $725,000, well, now it's gotten split like this. We have $217.5K. This is going to 5-year assets. Then we have $145. This is going to 7-year assets. And then we have 108 we'll say 8 to 15-year. And then the remainder of 253.8, that is going to our standard useful life of 27 and a half years. So I want to just use a different color really quick because I want you to know these 3 amounts right here are entitled to something called bonus. And so if we go back up in our example, remember I said the bonus rate was $40,000. So what does that mean? That means in year 1, this is in 2025, the bonus depreciation rate is 40%. So that means if you were to do this in 2025 and this property was placed in service, you would be able to take $188,500 of expense right now. Don't have to wait 30 years, almost 30 years to be able to take this expense. You're able to take this right now. So what does that mean from a tax perspective? Well, if we go back here, we're going to do it side by side. So we're going to start with that same NOI, and I want to write this in green because this is where the money is at, right? So we have 45,000. We'll just put CS here because we want to know that that's the cost seg one, and then we'll say non-CS here. So we know the NOI is the same. Now, this is the depreciation that we are able to take for this year is $240,605.84. So $240,606. That's what we're able to take. That gives us a taxable income of a loss of $194,006. $194,006. That means that our tax owed for the year is zero on this. Now, let's layer on another scenario. In another video, I'll talk about what it means to be a real estate professional. But with real estate professional status, this loss, because normally what happens is that it is passive. So that means you're only able to take that loss against other passive income. So an example would be you invest in real estate, but you also invest in mutual funds, stocks, etc. You'd be able to take this loss against any capital gains that you, but what happens if you're a real estate professional? If you are a real estate professional, you are now able to take this loss here and offset your active income because now it's active. Because with real estate professional status, you are a real estate professional, which means real estate is your business, which means any losses that are generated through real estate offset any income, other business income, or W-2 income that you earn. So let's give you an example. I have a client right now who I can think of. I have several clients like this, and this is what they do. The spouse is a real estate professional, and then the other spouse, the husband, is a W-2 earner, earning multiple six figures, almost seven figures in income. This strategy right here saved both of my clients over $200,000 in taxes because they layered on a cost segregation with real estate professional status. Let's just move this really quickly. If you have your partner makes $500,000, well, at 37%, that tax is $185,000. That's a lot of money. That's more than some people make in a year. But look what happens when we're able to now take this taxable income, this taxable loss against that $500,000 in income. So we could do 500,000 and we will subtract out the 194,006. That now gives us taxable income of $305,994. And when we take 37% here, well, now the tax due is $113,218. Well, just with one strategy, not using any other strategies, we were able to reduce this person's tax bill over $70,000. That is the power of a cost segregation. If you found this video helpful, I have another walkthrough just like this on the subject of depreciation. You can click the link right here and watch it now.